Well, good morning, Benjamin Stackers. Welcome to Money in the Morning with Stacky Benjamins. Grab your coffee, pop on the headphones, get your personal finance on. I'm Joe Saul-Sehy, Average Joe Money on Twitter. Let's get your morning started. Today we spun the What's Today's Headline, and it landed on two things. Number one, diversification for results. And then number two is bad auto loans. We're going to get into that in just a moment. But first, this show is brought to you by Stacky Benjamin's Courses. Want to learn about money, but afraid of those courses by nerds who talk over your head like the guy who repairs your computer? Well, guess what? We've got you covered, from saving half your income to building a millionaire mindset to legally cheating on your taxes, even with the new tax law. We've got it all. Learn.stackybenjamins.com. Get your learning on at learn.stackybenjamins.com. All right, big show today. We've got stuff to do this morning, so let's get into our headlines.
Hello, darlings. And now it's time for your favorite part of the show, our Stacking Benjamin's Headlines.
Marcia joins us live today from Cape Town. Hello to you, Marcia, from Texarkana, from the basement. Our first headline comes to us from Kiplinger. Is it Kiplinger or Kiplinger? I don't know. They gave us best podcast, and I still don't know how to pronounce that. But it comes to us from Kiplinger. I found this very interesting. Don't trust a pie chart to test diversification. This is written by Mike Halfling, investment advisor representative of Veris Capital Management. He said, it's hard not to be confident considering that the S&P 500 index is up almost 300% since its low point back in March of 2009. That is so funny. Okay, this is our second time we've done this. And I wasn't taping for the podcast. I have the button pressed. I have the button pressed, but I don't have the button. So the most important thing is to get it right for the podcast. So we're going to start over. Hey, Kimberly. Hey, Gary. Just ignore all that. We're going to begin again. You get to see everything here when you're here on Facebook Live. All right. Take two. Good morning, Benjamin Stackers. Welcome to Money in the Morning with Stacky Benjamins. Grab your coffee, pop on the headphones, and get your personal finance on. I'm Joe Saul-Sehy, Average Joe Money on Twitter. Well, today we spun the wheel of what's today's big headline. We've got two of them. First one is about diversification, not trusting pie charts. And number two is bad auto loans. Let's get into both those in just a moment. But first, this show is brought to you by Stacky Benjamin's Courses. Want to learn about money, but afraid of those courses by nerds who talk over your head like the guy who repairs your computer? Well, guess what? We've got you covered, from saving half your income to building a millionaire mindset to legally cheating on your taxes, even with the new tax law. We've got it all. Learn.stackybenjamins.com. Get your learning on at learn.stackybenjamins.com. All right, big show today. We've got a ton to do. We actually recorded this once partly and realized we weren't taping for the podcast. So now we got everything set up. So let's really get into this.
Hello, darlings. And now it's time for your favorite part of the show, our Stacking Benjamin's Headlines.
Our first headline comes to us from Kiplinger. We're going to say it that way. Kiplinger. This comes to us from Mike Halfling, investment advisor representative for Veris Capital Management. He says, don't trust a pie chart to test diversification. I found this really interesting, guys, because, to his point, he says, it's hard not to be confident considering the S&P 500 index is up almost 300% since its low point back in March of 2009. Even more incredible is the fact that 2017 has been the least volatile year in over 50 years. But with confidence comes complacency. And I totally saw this, by the way, when I was a financial planner. And even when people write letters, we received a lot fewer nervous letters this last year, even though our listenership is up on the Stacking Benjamin show. Far fewer nervous letters. And yet, really, as the stock market continues to rise and PE ratios go up a little bit, this whole thing of reversion to the mean, it seems like as we make more and more money, we should be more and more worried, shouldn't we? But it seems like we're not. So to Mike's point, he says that when he meets with investors every day, he asks them basic questions to identify whether he can provide any value. So regardless of Mike, let's ask his questions. Number one, what's your current strategy to help mitigate investment losses? Do you have a strategy to help you slow down losses? If the worst happens, what do you do? And then number two, can you show me some specific examples of diversity within your portfolio? And three, what's the maximum loss of money you can tolerate at this point in your life? I found those pretty interesting. And actually, if you think about it, kind of basic questions that I think that most of us can't answer. And it's funny, when we get into diversification, a lot of people point to this pie chart, right? They point to a pie chart of how they diversify. And Kimberly, watching live on Facebook, says, don't trust pie charts. They aren't actually pie. So the name itself is misleading, right? If a pie chart doesn't include real pie, we shouldn't really follow it. But to really get into it, your pie chart of investments, just because you have different slices of the pie doesn't mean that you're actually diversified. And I saw this quite a bit. People would have 3 different funds, and maybe they have, I don't know, the Ariel Fund, the Fidelity Contra Fund, and some other random growth fund. And you look at the 3 of those, and really maybe 70% of what they own might even be the same exact companies. So just because you have 3 different things doesn't mean you're diversified. So what do we really want? And I will link to this in our show notes at stackybenjamins.com. But when you diversify your portfolio, you want that pie chart to be things that go up and down under different circumstances. The bad news is, in times like March of 2009, everything went down at the same time. So you really, even if you were diversified, you still would have lost a lot of money. But as an example, small company stocks go up and down differently than large company stocks do. Gold goes up and down differently, but we want to be careful there because gold runs in big surges and then comes back. Real estate goes up roughly the same as large company stocks, but under a different set of circumstances. Again, 2009, large company stocks, real estate, gold, all 3 went straight down. Bonds even went down. And so we won't even tell OG that we're talking about bonds today a little bit. But when you look at that pie chart, that's why you have international investments, emerging markets. A lot of people don't know this, that you can put spicier things with higher volatility, like emerging markets, into your portfolio. And because emerging markets move differently than large company U.S. stocks, you'll actually lower the risk in your portfolio because of the fact that things are going up and down at different times under different stimulus. So you can put individual things that are riskier in your portfolio and still come out with a less risky portfolio. But ask yourself that question: how much volatility can you take and still reach your goals? I think that's going to be different for everybody. But I love this piece. Don't trust just because you have a pie chart doesn't mean that it's actually a diversified collection of investments, is it? Let's move on to our second piece. Our second piece comes to us from the Magnify Money blog. Found this one also incredibly interesting. What to do if you're trapped in a bad auto loan. And I see this fairly often, sadly. It had to happen once to me, where I was told by the people that I was dealing with when we had an auto loan. This was way early in my driving life, that my auto loan, I had X terms, and it turned out that I really had Y terms. I had totally different things going on in my loan than I was told. This is written by Brittany Lareu. Brittany says, sometimes you don't realize you sign a bad debt until you start having to pay for it. Imagine this scenario. When you walked away from the auto dealer's lot, you were excited. You had a brand spanking new or new to you vehicle. After the hassle of saving for, finding, and finally purchasing your dream car, your financing terms were likely the last thing on your mind. When the dealer sat you down and told you what the monthly payment would be, you did some mental math, figured you could afford it, and signed on the dotted line. A few months later, you notice, it's not what you thought. So according to this piece, which I totally agree with, we've got 4 things that we can do. Number 1, try to refinance for a better deal. Just go online to a place like Magnify Money or wherever and find another financing that actually meets the terms that you want. Refinance the car over to a new lender. If your credit score was lower at the time you finance your vehicle, Brittany says, then you may have been given a less favorable loan terms. Understandably, can't always perfectly time a car purchase. Ultimately, by the way, we don't want a car loan, do we? But if you took one out and it's bad, refinance it to a better one. Option 2, negotiate your terms with your current lender. I think I might even try that one first, because if we don't have to hit up our credit score, I would really want to not go to my credit score first. I want to first see if I can just negotiate with the people I've got now. Then number 2, I might refinance to a better deal. Number 3, cut back on other spending in your budget. And then just so you can afford it, let's say that you've got horrible credit now, we're going to have to find other places to cut, aren't we? So some popular places to cut. Number 1, we see with this new tax law coming, you might have more money in your budget than you used to have. So that's number 1, but we really want to try to save that money. But entertainment spending, people just entertain themselves. They don't pay attention. Food out, meal planning can save you a good bundle of money. It seems like whenever Cheryl and I meal plan, we end up saving a ton of money by just buying groceries that we're going to eat instead of eating at a restaurant. Option number 4, sell your vehicle, start over. Hopefully the vehicle's not upside down. Sometimes when I was a financial planner, we had this where they couldn't get out of you couldn't get out of the loan because the vehicle was upside down. That's difficult. So first, I think I deal with your lender. Number 2, then I try to refinance to a better deal. Let's see if we've got any comments on either of these pieces from our people watching live on Facebook. Neighbor Doug says hello from Bangkok. Gary, I didn't know you were in Hawaii. Wow. We've got people all over the place. Marcia from Cape Town with us. Dave is late. Dave, why are you late? Dave says it was so cold last week. Robin went to Batman and said, the Batmobile won't start. Batman replied, check the battery. Robin thinks for a second, responds, what's a Terry? Check the Bat Terry. Oh boy. I think we're going to leave it there. Thanks everybody for listening. We'll see you tomorrow with more Money in the Morning.
Money in the Morning is created by Joe Saul-Sehy and is brought to our channels by our producer and engineer, Richie Rutter-Reese. Stacking Benjamins and Money in the Morning are for entertainment purposes. Before making moves, consult with your financial advisor. Looking for training sessions? Kathleen Selmans has a great suite of Stacking Benjamins tools, so head on over to learn.stackingbenjamins.com. Hoping to chat with us on the web? Say hello to Shannon Cowan, our social media guru and community manager in our Facebook group. She can be found at stackingbenjamins.com/basement. From the basement, I'm Joe's mom's neighbor, Doug. See you tomorrow.